Home equity loans have become a popular financial tool for homeowners seeking to leverage the value they've built up in their property. Whether for large expenses such as home renovations, education costs, or consolidating debt, a home equity loan can provide significant monetary resources. This article aims to offer a thorough exploration of home equity loans, including how they work, their benefits, potential drawbacks, and how to secure one. What is a home equity loan? A home equity loan is a type of secured loan where the borrower uses the equity of their home as collateral. Equity is the difference between the value of the property and the amount still owed on the mortgage. For example, if your home is valued at $300,000 and you owe $100,000 on the mortgage, your equity is $200,000. Home equity loans are also known as second mortgages because they are secondary to your primary mortgage in priority and repayment. They are typically disbursed as a lump sum and have a fixed interest rate, meaning the monthly payments and the loan term, often 5 to 15 years, remain constant. How do home equity loans work? To understand how home equity loans work, it's important to consider the application process, the disbursement of funds, and the repayment phase. Application process. To qualify for a home equity loan, you'll need sufficient equity in your home. Lenders typically require that you retain at least 15 to 20% equity after borrowing. You'll also need a good credit score, usually 620 or higher, although some lenders may require higher scores. The process includes an appraisal of your property to confirm its market value. Repayment. Repayment typically begins immediately after the loan is disbursed. The loan has a fixed interest rate, so the monthly payments remain consistent throughout the term of the loan. Early repayment can often be done without penalty, but this depends on the lender's terms. Benefits of home equity loans. Home equity loans offer several advantages. Fixed interest rates. The predictability of fixed rates makes budgeting easier. Potential tax benefits. Interest paid on a home equity loan might be tax deductible if the loan is used to buy, build, or substantially improve the taxpayer's home that secures the loan. Lump sum funding. Receiving money in a lump sum is useful for covering large expenses. Risks and drawbacks. Despite their benefits, home equity loans carry risks. Risk of foreclosure. Because your home serves as collateral, failing to make payments can lead to foreclosure. Borrowing costs. These loans come with closing costs and potentially other fees, which can add up. Comparing home equity loans with HELOCs. It's important to differentiate between a home equity loan and a home equity line of credit, HELOC. A HELOC works more like a credit card, allowing you to draw funds as needed up to a certain limit during the draw period. Interest rates are usually variable, making monthly payments less predictable than those for home equity loans. How to get a home equity loan. To obtain a home equity loan, follow these steps. Assess your financial health. Check your credit score and gather financial documents. Determine your equity. Estimate the current value of your home and subtract any amounts owed on a mortgage. Shop around, compare rates, fees, and terms from multiple lenders. Apply. Complete the application process, which will include verification of income and a home appraisal. Home equity loans can be a valuable financial resource when used wisely. They offer a fixed interest rate and predictable repayment schedule but require careful consideration due to the associated risks, notably the potential for foreclosure. By understanding the mechanics of these loans, assessing personal financial readiness, and diligently researching potential lenders, homeowners can make informed decisions that capitalize on their home's equity while mitigating financial risk. Home equity loans have become a popular financial tool for homeowners looking to leverage the value they've built up in their homes. These loans can be used for a variety of purposes, from remodeling your home to consolidating debt. However, while they offer substantial benefits, they also carry risks that must be carefully considered. Home equity loans can be a valuable financial tool, but they come with inherent risks, primarily the threat of losing your home. Before deciding, weigh the benefits against the potential drawbacks and consider your financial situation and long-term goals. With careful planning and consideration, a home equity loan can be a smart financial move for many homeowners. A home equity loan, often referred to as a second mortgage, is a type of loan in which the borrower uses the equity of their home as collateral. Equity is the difference between the current market value of the property and the amount the owner still owes on the mortgage. It is essentially the portion of the home that the owner truly owns. Home equity loans are typically used to finance major expenses such as home renovations, college education, or medical bills, as they often come with lower interest rates compared to other forms of unsecured debts, like credit cards or personal loans. When it comes to financing major expenses, such as home renovations, education, or debt consolidation, many homeowners turn to home equity loans. Qualifying for a lower interest rate on a home equity loan often involves several factors. Here are some strategies that might help. Improve your credit score. Lenders often offer the best rates to borrowers with high credit scores. Paying your bills on time, reducing your debt levels, and regularly checking your credit report for errors can help improve your score. Maintain a low debt-to-income ratio. Lenders look at how much of your income goes towards paying debts. Lower ratios often result in better rates. Have sufficient home equity. The more equity you have in your home, the less risky the loan is for the lender, which could result in a lower interest rate. Consider a shorter loan term. Loans with shorter terms often have lower interest rates. However, this will increase your monthly payments. Shop around. Different lenders offer different interest rates. Getting quotes from multiple lenders can help ensure you get the best rate. Remember, it's important to do your research and consult with a financial advisor before making decisions. Calculating your home equity is a relatively straightforward process. Here's how you can do it. Determine the market value of your home. You can get a rough estimate by looking at the sale prices of similar homes in your neighborhood, or you can hire a professional appraiser for a more accurate assessment. Find out how much you owe. This is the total amount you owe on your mortgage. You can find this information on your most recent mortgage statement. Subtract the amount you owe from your home's market value. For example, if your home is worth $300,000 and you owe $200,000 on your mortgage, your home equity is $100,000. Remember, as you pay down your mortgage or if your home's value increases, your equity grows. However, if your home's value decreases, your equity decreases as well. It's also important to note that while home equity can be a valuable asset, it's not liquid, and accessing it requires borrowing against it or selling your home. Thank you for joining us on this financial journey. We hope today's insights have added value to your financial literacy. Remember, financial success is a journey, not a destination. If you enjoyed today's content, don't forget to hit the like button, share with your friends, and subscribe for more insightful videos.